While a single currency covers the European continent, the underlying fiscal landscape remains fractured along national borders. The creation of the euro forced a monetary union, a single centralized currency, onto nations that maintained entirely separate fiscal unions, keeping their own distinct taxation and debt systems. Establishing a shared currency without consolidating sovereign debt removed the natural free market mechanisms nations use to absorb economic shocks. The volatility of those shocks did not disappear. It was transferred directly out of the currency markets and into domestic bond markets. This pressure concentrated risk within domestic banking systems, creating a self-reinforcing crisis across the continent. To arrest that loop, the European Central Bank drove interest rates below zero, trapping itself in a policy paradox it cannot easily escape. Understanding the current fragility of the Eurozone requires looking past the political messaging of unity and deconstructing the mathematical fissure between its monetary and fiscal architecture. When the euro officially launched in 1999, it did so without consolidating the national debts of its member states into a single European debt market. European Commission planners were explicitly warned in 1997 that this omission was a fatal error. They proceeded anyway, knowing that selling a unified debt burden to the European public was a political impossibility. The strategy was to introduce the currency first and negotiate the debt consolidation in a later phase. That phase never arrived. On the left, a structurally sound system like the United States features a central bank managing a currency backed by a massive, unified treasury market. On the right, the European Central Bank issues one currency, but the debt backing it splinters into isolated national obligations. Global capital requires a deep, liquid reserve to park massive investments safely and use as international collateral. The US dollar functions as the world's reserve precisely because that unified treasury market provides absolute liquidity and depth. Without a consolidated debt market to act as a deep reserve, the euro structurally cannot absorb the same volume of international capital, leaving it without the shock absorbers required of a major global currency. When an independent nation suffers a localized economic shock, the free market automatically responds by devaluing that nation's currency. Devaluation acts as a pressure valve. The country's exports suddenly become cheaper on the global market. Foreign capital flows in to buy discounted goods, and international payments naturally balance out. By adopting the euro, economically diverse nations permanently surrendered that pressure valve. For an individual member state, utilizing the single currency operates exactly like a rigidly pegged exchange rate. This graph illustrates volatility transfer. Suppressing price movement in one market forces it into another. Normally, a shock hits and the currency fluctuates to absorb the impact, while bond yields remain stable. When the currency is locked, that exact shock violently spikes domestic bond yields. Imposing a single interest rate across unequal economies did not denominate macroeconomic stress. It redirected that stress straight into local bond markets. Because there is no single European bond, commercial banks across the Eurozone load their balance sheets with the fragmented sovereign debt of their own specific governments. Consider a localized shock hitting a weaker Eurozone economy, like Athens. On a domestic bank's balance sheet, rising macroeconomic risk causes investors to sell off the nation's sovereign bonds, severely dropping their market value. Because banks hold these exact bonds as reserves, this price drop inflicts an immediate capital loss. Nearing insolvency, the bank stops lending, starving the economy, which loops back to drive sovereign bond values down even further. The European Union's political architecture exacerbates this by rejecting cross-border bailout, preventing German capital from rescuing Italian banks, for example. They rely on localized bail-ins that trap the damage strictly inside the afflicted country. Technical proposals to engineer a bundled European safe bond to diversify this specific risk across borders have repeatedly failed to materialize. Removing the mechanism of currency fluctuation causes localized sovereign distress to translate directly into private banking insolvency. The institution tasked with managing this structural contradiction is the European Central Bank. In 2014, desperate to stimulate stagnant economies and arrest the banking doom loop, the ECB introduced negative interest rate policy. Pushing yields below zero effectively inverted the European bond market, penalizing capital instead of rewarding it. Look at this solvency gauge for European pension funds. Negative interest rates wiped out the yields these funds required to meet obligations to citizens. Because commercial banks are heavily loaded with artificially low-yielding bonds, the ECB cannot safely raise rates today. If the central bank raises rates, the principal value of those massive bond portfolios will collapse. Negative interest rates trapped the ECB. Normalizing monetary policy now threatens the immediate insolvency of both commercial banks and the central bank itself. The missing debt consolidation, the banking doom loop, and the ECB's current trap are the outcomes of a specific design choice. Planners prioritize the euro's function as a political project over its long-term economic stability. The architecture of the euro was aimed at creating an alternative to US dollar dominance, using currency to force the federalization of Europe through the back door. Achieving that integration meant intentionally bypassing democratic referendums that would have rejected the loss of national financial sovereignty. German Chancellor Helmut Kohl explicitly admitted he operated as a dictator to force Germany onto the euro, fully aware the public would have voted against it. The Eurozone remains a political construct governed by top-down control. Until the fissure between centralized money and fragmented debt is resolved, the system remains structurally incapable of genuine economic integration. The missing debt consolidation, the banking doom loop, and the ECB's current trap are the outcomes of a specific design choice. Planners prioritize the euro's function as a political project over its long-term economic stability. The architecture of the euro was aimed at creating an alternative to US dollar dominance, using currency to force the federalization of Europe through the back door. Achieving that integration meant intentionally bypassing democratic referendums that would have rejected the loss of national financial sovereignty. German Chancellor Helmut Kohl explicitly admitted he operated as a dictator to force Germany onto the euro, knowing the public would have voted against it. The Eurozone remains a political construct governed by top-down control. Until the fissure between centralized money and fragmented debt is resolved, the system remains structurally incapable of genuine economic integration.